Silver just crashed 6.9% in 48 hours. But while paper prices collapsed, physical buyers in Shanghai started paying $15 more per ounce than the spot price. Two prices, two continents. One of them is lying about what silver is actually worth. And if you're holding physical silver right now, the answer determines whether your stack is worth what the paper market tells you or what the largest physical market on earth is willing to pay. By the end of this video, I'm going to show you exactly why this gap exists, who benefits from the disconnect, and which price is telling you the truth about where silver goes next. But first, ask yourself something. When was the last time a price crash made physical buyers pay more? That is not how supply and demand is supposed to work. When something drops in price, demand should cool off. Buyers should wait, premiums should shrink. But in Shanghai, they are doing the opposite. They are paying $88 an ounce, while paper says $73. That $15 gap did not narrow during the crash, it widened. Here is a number that should stop you cold. The Shanghai premium has not been this wide since 2020, when physical silver literally disappeared from dealer shelves worldwide. Silver went from $13 to $30 in just 4 months. The premium was the warning shot. Nobody listened then, but I want to make sure you listen now. So let us break down what this gap actually looks like in real numbers, because the mainstream financial press is barely covering it. Pay close attention here, because this section contains the data that changes everything about how you should think about this crash. The paper spot price closed at roughly $73 an ounce after the 6.9% sell-off. This is the price that shows up on your phone. This is the price financial media reports. This is the price most investors use to value their holdings. But that price is a fiction. It represents a paper contract, a promise to deliver silver that may or may not exist in a vault somewhere in New York. On the Shanghai Gold Exchange, the same ounce of silver is trading at $88, not in theory, not in futures, in physical delivery contracts, where actual metal changes hands and leaves the vault. Here is what this means if you are holding 100 ounces of physical silver right now. The paper market tells you your stack is worth $7,300. Shanghai says it is worth $8,800. That is a $1,500 difference on a single 100-ounce position. And the gap has been growing every single day. Think about what that really means for a moment. Same metal, same purity, same weight, but a $1,500 difference depending on which continent you stand on. To put this in perspective, the average Shanghai premium over the last decade has been between $2 and $4 per ounce, not 15. The last time this gap approached double digits, it preceded a 60% rally in silver over the following 6 months. The premium is not noise. It is the physical market screaming that paper and physical silver have completely divorced from each other. So why would sophisticated buyers in Asia's largest metals exchange voluntarily pay 20% above spot? Are they overpaying? Are they making a mistake? Or do they know something that Western paper markets are actively suppressing? Let us investigate. I want to follow the actual supply chain because that is where the truth always lives. What I found when I dug into this changes the entire narrative around this crash. The first factor is vault drainage. The registered silver inventory sitting inside COMEX vaults, this is the silver that is actually available and earmarked for delivery, has dropped to levels not seen since 2019. We are talking about fewer than 30 million ounces remaining in deliverable form. Here is what this means. If you are a stacker, every single day, more contracts stand for physical delivery than new metal enters those vaults. The registered pile is shrinking at an accelerating rate. And when it gets low enough, the paper price mechanism breaks entirely because you simply cannot set a credible price for something you do not have. Let me give you one specific number that tells the whole story. In the last 90 days alone, over 14 million ounces have been withdrawn from COMEX registered vaults. That is nearly half of what remains. At this current drain rate, COMEX registered inventory could hit single-digit millions by this summer. The second factor is Chinese industrial demand, and this is where the East versus West divide becomes impossible to ignore. China consumes over 200 million ounces of silver every single year just for solar panel manufacturing. Their domestic mine production does not even come close to covering it. They must import. There is no alternative. And here is the kicker that makes this crash look like a gift to Chinese buyers. Chinese solar panel installations hit record highs in Q1 of 2026, pushing industrial silver consumption to levels that make last year look like a warm-up act. When paper price crashes, Chinese manufacturers do not panic sell their silver holdings. They buy because they need the actual metal to run their factories. You cannot build a solar panel with a futures contract. You need physical bars. What this means for your position is simple and powerful. The single largest consumer of physical silver on the entire planet views this crash as a buying opportunity, not a warning sign, not a reason to sell, a discount on a critical industrial input they will consume regardless of price. Now, here is the question you should be asking. If China is buying physical at a $15 premium and industrial demand just hit record highs, then who exactly was doing all the selling last week? The third factor answers that question, and it reveals the mechanism behind every single silver crash of the last decade. Managed money positions, hedge funds, algorithmic traders, and momentum-following programs liquidated over 35,000 COMEX silver futures contracts in the last 5 trading sessions alone. That is the paper equivalent of 175 million ounces of silver dumped onto the market in under a week. Think about that number for a second. 175 million paper ounces were sold, while fewer than 30 million real ounces sit in COMEX vaults available for delivery. The paper market just sold 6 times more silver than physically exists. This is the mechanism. Algorithms crash the paper price based on momentum signals. Physical buyers in Shanghai, Singapore, Dubai, and Mumbai step in and buy the real metal at whatever premium the market demands. The gap between paper and physical widens, and then every single time, paper eventually catches up to physical. Speaking of positioning during moves like this, if you want to trade silver or gold with leverage, WEEX offers no KYC and a $30,000 sign-up bonus for new accounts. Link is in the description. Remember that $15 premium I showed you at the start of this video? Now you understand why it exists. It is not a glitch. It is not a market inefficiency. It is the physical market telling you, in the loudest possible terms, that paper price suppression has reached its breaking point. The real price of silver is not $73, it is $88, and here is why that distinction matters more right now than at any point in the last decade. If this data surprised you, hit the like button right now. It helps this video reach other stackers who need to see these numbers before it is too late. The revelation is this: the Shanghai premium functions as a pressure gauge for the entire global silver market, and right now, that gauge is approaching the red line. Every single time, the Shanghai premium has exceeded $10 in the last 5 years. Every time without exception, the paper price has eventually caught up to the Shanghai physical price, not the other way around. Physical never comes down to paper. Paper rises to meet physical. In 2020, the Shanghai premium hit $8 when paper silver sat at just $13. Within 4 months, paper caught up and silver hit $30. That was a 130% move. In 2022, the premium touched $6 when paper was trading at $20. Within 3 months, silver rallied to $26, a 30% move. Here is what this means for your stack right now. If the historical pattern holds, and it has held every single time, paper silver at 73 does not stay at 73. It gravitates toward what physical buyers are actually paying. That represents a minimum upside of 15 to 20% from current levels, with historical precedent suggesting the move could be significantly larger. But there is another layer that nobody is talking about yet. JPMorgan currently holds the largest long position in COMEX silver futures in the bank's entire history. They are not short. They are betting on higher prices. The same institution that paid $920 million in 2020 to settle precious metals manipulation charges is now positioned for a massive silver rally. Ask yourself this question: why would JPMorgan go massively long silver while paper prices crash and retail investors panic sell? They have access to vault data. They see the Shanghai premium in real time. They know industrial demand numbers before the public does. They know exactly what the Shanghai premium is telling us. They know vault inventories are draining at record pace. They know Chinese industrial demand is at all-time highs, and they are positioning accordingly. Subscribe and hit the bell if you want these supply and demand alerts before mainstream media catches up. Every week, we break down the data points that Wall Street quietly tracks but never shares with retail investors. The crash was not a market judgment on silver's fundamental value. It was a mechanism, an engineered shakeout designed to flush weak hands from the paper market while physical accumulation accelerates in the East. The paper market is the stage. Shanghai is the real economy. So what does all of this mean specifically for you and your physical position? Let me put it in concrete terms with actual dollar values. If you are holding 100 ounces of physical silver, a common stacker position, here are the two scenarios you need to understand. Let us run the actual numbers right now. Conservative scenario: paper price closes the gap to Shanghai over the next 3 to 6 months, reaching $88 per ounce. Your 100-ounce stack goes from a paper valuation of $7,300 to $8,800. That is a $1,500 gain, 20.5% upside, simply from the paper market acknowledging what physical buyers in Asia already know today. Bullish scenario: the premium widens further before convergence as COMEX registered inventory hits critical levels this summer, pushing the true physical price above $100 per ounce. Your 100-ounce stack reaches $10,000 or more. That is a 37% gain from today's paper price, and it does not require any new catalyst. It only requires the paper market to stop pretending physical silver is worth less than what people are actually paying for it. Here is the one concrete action you should take right now. Do not sell physical silver into a paper crash. The Shanghai premium is telling you that your physical metal is more valuable today than it was before the crash, not less. The paper price went down. The real-world price went up. Act accordingly. Drop your current stack size in the comments below. I want to know how many of you are holding through this shakeout and whether you are adding ounces at these paper prices. Let me know your target. Remember what I asked at the very start of this video. When was the last time a price crash made physical buyers pay more? Now you know the answer. It happens when the paper market and the physical market are telling two completely different stories about what silver is worth. And every single time this has happened before, the physical market won. Paper catches up. It always does. The $15 Shanghai premium is not just a number on a screen. It is a signal. It is the physical market voting with real money, hundreds of millions of dollars in actual metal purchases, while paper markets vote with algorithms and leverage. And history is undefeated on this point. The real money wins every single time. If you want to stay ahead of these signals, subscribe and hit that bell. I will have the next update as soon as COMEX Vault data refreshes on Wednesday. And check out this video right here. It breaks down exactly why COMEX registered inventory is draining at record pace and what the timeline looks like for a full physical delivery squeeze. I will see you there.